Good morning and welcome to this Wednesday, December 1st, 2021 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, if you're sitting at the casino, maybe the roulette wheel, you're hitting black today. It's been red and black every other day. It depends on which day you wake up as far as the futures go. But today you hit if you're on the long side, because we got futures up about 350 points on the Dow, 59 on the S&P 500, and about 210 on the NASDAQ. So it looks like we're gonna have a strong open today. So it's been every other day of late. We had that bad day on Friday, kind of kick-started things with the COVID-19 variant, the Omicron variant. Then Monday rallied back up as if nothing ever happened. Then all of a sudden it was the Omicron again yesterday, with the market selling off. We'll go over those numbers in just a minute. And then now today we've got futures bright green again. So if you can figure out which way the market's going to go in the morning, I congratulate you, because I honestly have no idea from day to day what's going to happen in the market. I do feel pretty strongly still long term. I don't see any damage whatsoever to the technical picture. So outside of these pullbacks along the way, I still think the long term is very bullish. I think we're going a lot higher over the next several years. But day to day and even week to week can be a lot more challenging to try to figure out. And so you just have to be prepared for both, to be quite honest. And if you're a long-term investor and you don't really want to get involved in the short term, then I would say just turn your news channels off and just hang on. That's my opinion. Of course, you have to decide what you want to do for yourself. I can't provide advice, but that's my opinion. If you're short term, though, you've got to decide if you're willing, to ride this roller coaster. You could sit it out, obviously, with cash. You could be fully long. You protect yourself with maybe some puts, some kind of insurance to the downside in case the market gets caught up in this new variant. Because I honestly don't know. I mean, the scientists apparently don't know, exactly what we're going to see from this variant as we go forward. So, the headlines are probably going to drive the market in the short term. They do. That's what, I think that sometimes is what some of these Wall Street firms want. I think they actually would like to see pullbacks from time to time. So having someone go out, in the media and say, hey, this thing's run too far, or we could be in trouble with Omicron. We could be, staring at, 5 or 10% sell off, whatever it is, you have to question the agenda of whoever's saying that. And, billions of dollars are at stake. This isn't, little piddly stuff. I mean, we're talking about a lot of money. And, if Wall Street can get in a little cheaper, why not? Anyhow, that's all just my opinion. I like to rant once in a while. Looking at the futures, though, I mean, it does look like we'll get off to a good start this morning, and then we'll see what happens after that. We are in an uptrend. I'll go through all those numbers with you in just a minute. For those of you that are new to Earnings Beats, I always like to start the show with, and I've got to make sure I'm getting the right screen here. Hopefully this is the one that's working. Aaron, let me know if it's not. Otherwise, I'll keep going. If you're new to Earnings Beats, simply scroll down, go to earningsbeats.com, scroll down. We have a free newsletter. If you're interested in finding out a little bit more about us or understanding who we are and some of the things that we look for, this is probably the best way to start. You can sign up for free, just name, email address, no credit card required. Hit that subscribe button. We'll get a newsletter article out to you 3 times a week, Mondays, Wednesdays, and Fridays, usually in the morning, an hour or so before the market opens. It's a couple paragraphs and a chart. It's a very easy read, but it's going to focus on things that are really important to us. It could be sector or relative strength. It could be individual stock, relative strength versus peers and so forth. Candles, candlesticks. It could be earnings related gaps. I mean, these are the types of things that are really important to us. But if you want to learn more and you're listening in maybe for the first or second time today, I would highly recommend that you go in and sign up for the free newsletter. You can unsubscribe at any time. We're not going to hold your hand to the fire here and keep you in if you don't want to be in, if that's something you're not interested in. But it is a great way to get to know us a little bit. Let's move on. We got a lot to go through today. We got the market recap first. Dow Jones Industrial yesterday down 652 points, moving to a fresh new low. And when I say fresh new low, I'm talking about in November. Clearly, you can see the lows that we've seen over the last several months. We're still above those. I really would like to hold all these lows. I mean, this is a pretty good support range in here. Let's call it 33,250 up to about 3,400, right in here. So we went down below 34.5, just a little bit below 34.5 yesterday. Still a little bit of room to the downside with futures today. We're looking to open back up, but we still got the overhead resistance in terms of those moving averages that we're going to have to contend with. But if we're sideways consolidating, moving averages become less relevant. Moving averages are much more important when you're trending. So if we go up, we hit the moving averages, and then we go back down to a new low, that's telling me that we're trending, at least in the short term, to the downside. If we go right back up through it, then I'm thinking more consolidation. Moving averages tend to just kind of support price action in a trend. So if you're going up, moving averages usually provide you support underneath. When you're going down, moving averages act as resistance. So that's something to watch. But not all areas of the market are the same, and we'll go through that on the rest of these charts. The S&P 500 also, like the Dow, and we're going to look some more at the S&P in just a couple of minutes, but trending lower below the 20-day, still above the 50-day though. So you can see a little different configuration here. The PPO on the Dow has gone negative. On the S&P, it's not. So again, a little bit different configuration. NASDAQ just a little bit below its 20-day moving average, not too much below, only about 150 points. But of course, in this market, today, for instance, right now, I've got NAS futures up almost 200 points at last check. So that's, going to put us right back up above the 20-day. So that's what I'm talking about in terms of consolidation, where the 20 is just not acting as resistance or support. We're just kind of going back and forth through it. Mid caps and small caps, however, look a lot like the Dow. Big drops below both the 20 and the 50. Got this support from the last 4 to 6 months that we need to watch. But right now, we're still okay. I'm surprised. I'll be honest. I'm surprised that mid caps and small caps have fallen as far as they have. I would have thought with their recent breakouts that they were going to continue moving higher. We haven't seen that. And they've not only have they moved lower, but they've been the weakest area of the market. Communication services. So yesterday, all 11 sectors were lower. So this is like a little game we're playing right now. We go up with all 11 sectors going up. We go down with all 11 sectors going down. We've done this now, I think, 4 days in a row. I believe each day we've been down, we've had all 11 down. Each day we've been up, we've had all 11 up, I believe. Maybe I'm wrong. But if that's the case, I can't remember the last time we've done that 4 days in a row. And to the upside or the downside, or a mixture of both. I mean, it seems like everything's horrible one day and everything's great the next, and then everything's horrible again, then everything's great. In the short term, this drives you crazy, especially if you're chasing. If you see the market up, you're like, oh, I better get in. Then the next day it gaps back down. Oh, I better get out. And now I better start shorting. And then the next day it's back up again. I mean, this is crazy. You got to be careful if you're, if you find yourself emotionally going after the market. I think that's a big, big mistake. So with the 11 sectors down, communication services the worst, down more than 3%. I'll talk about this one a little bit. We do have a pattern breakdown there. Utilities down almost 3% on Tuesday. You can see that move down, taking out $66, which I thought was reasonable short-term support. We certainly could open the door down to 63, 64, but with futures up today, maybe we're going to go back up to 69. Who knows, right? Staples also falling below the 50-day moving average, yesterday down more than 2.5%. So it looks like a little problem there, but we still do have an uptrend. I mean, all of these charts, and even communication services, which definitely is broken down in the short term, pull up a long-term weekly chart. Yeah, I mean, we're definitely pulling back, but the overall long-term chart's very bullish. Industrials, you can see also falling below the moving average. The PPOs, some of the PPOs have gone negative, some haven't. But clearly, one of the best areas continues to be technology, and I would throw consumer discretionary in there as well. And those two groups, those are why we're still seeing decent action on the NASDAQ. Technology still above its 20-day moving average. Not too many groups are with the selling that we've seen over the course of the past few days. But technology, big volume, and we did finish lower, but this was the best group, only down 0.8%. So if you're wondering, if you've got a lot of stocks that are down, you're wondering why the S&P is holding up as well as it is, or the NASDAQ's holding up as well as it is. It's because of some of these large cap tech names or the large cap consumer discretionary names. I mean, Apple had a big day yesterday. I'm going to show you that chart in just a second. Apple, is a big piece of the S&P 500. It's a big piece of the NASDAQ. And so when it has a big day, it helps to offset weakness that we're seeing in other areas. Same goes for Tesla in the consumer discretionary area. Tesla doesn't seem to want to come down. I mean, it's come down from its high, but considering how far it ran, it really hasn't given up that much. So you've still got some of those large cap stocks that are really helping the overall market. Moving on to the 10-year Treasury yield, let's get an update here. We did have a couple, we had one economic report out. We got a couple more coming out. The November ADP employment report. So this is the precursor to Friday's non-farm payrolls. This report came out slightly better than expected. And I say slightly better than expected. I think that's probably a good thing for the market, either slightly better or slightly worse. I think the market kind of likes understanding where things are going. And so today we came out, jobs were 534,000. Expectation was 525,000. So I'm looking at the 10-year Treasury yield, and I haven't annotated it in a while. So let me just annotate real quick. A couple of the key levels I'm watching. If you see all these tops coming across here after we had gone down, had this little wedge almost form in here, and then we broke back out above it. So I had multiple tops at about 137, 138, and then we broke out above it. Haven't gone down to test that level yet. So this move that we're in right now, maybe we're going to go down and test it. If we fall below it and start moving back down toward the 113, 115 area, I think that could spook certain areas of the market. It's probably going to relate to COVID, I believe. If the 10-year Treasury yield drops that much, it's probably because COVID, we're getting more bad news or news that maybe isn't good news. And as a result, money's flocking into Treasuries safety, and that will send the yields down. Other than that, I'd be surprised if we go down below 137. I mean, I think, economy's strong. Most of the signs that I see are pointing to a strengthening economy down the road, with the one variable being this COVID variant, the Omicron, and whether or not, countries around the globe feel the need to shut down again. I mean, obviously, if that happens, or even the threat of it happens, we're going to see the yield going down substantially. So watch 137 to the downside. Upside, I would say, that double top right there, and then you've got the high from back in March. So I would say that area is key in the near term. So I just think we're moving back and forth, sideways consolidating right now. I don't look at this as being an uptrend or a downtrend. I mean, really, we topped out back in March, pulled back to an area where we had broken out from back in July and August, double bottom, and now we're just in the middle of that range. So I don't really look at this from an intermediate perspective as being higher or lower until we either take out 175 or potentially go all the way down below 113. Now I say that, but really 137 is short-term the number I'm watching. And with the yield struggling here, of course, that's going to put pressure on financials on a relative basis and industrials. Look at the industrials. This one is a head scratcher for me. I really thought industrials were ready to go. And I'm still not convinced they're not, but I did not think we would go back and set a new relative low on the industrials. I really didn't think that was coming. But of course, I didn't think that there was going to be another COVID variant coming out, spooking the market when it did. I mean, they can come up anytime, but you can't sit back and say, okay, it's time for a COVID variant. I mean, they happen, but you just don't know if they're going to happen or when they're going to happen. But it's part of what we have to deal with and what we have to evaluate the market. So that's what we try to do. Later today, we have the November PMI manufacturing coming out. 59.1 is the estimate. Then the same time, ISM manufacturing 61.1 is the estimate. October, by the way, was 60.8. So we're looking for a little step up in manufacturing, which is why I don't understand why the industrials are doing what they're doing, unless maybe we're going to have a disappointing report or two coming up. Who knows? October construction spending expected to rise 0.6%. September fell 0.5%. So we're looking for a little reversal, but we are talking about October. I mean, today's December 1st. We've now moved into the last month of the year, and we're still talking about October when it comes to construction and, home construction, home building. All of their reports tend to be outdated for the most part. And so I'd much rather watch the charts than to watch their, look at their economic reports. All right, moving on, talking technically, the spider. All right, well, S&P 500. What are we going to do here? What's the market going to do? Well, short term, obviously, we're pulling back. I would have expected maybe the 20-day, although we did break out with a falling PPO. I mean, false breakout in the falling PPO is generally not a great sign. It's not got a great look to it. But we never actually, I don't think, ever got a close above the prior close. Looks like maybe equal closes. But if you look back, another example was back in April. Here we actually did close a little higher, and look at the PPO rolling over from about this same level, a little over 1.5. This is right about 1.5. But I just think we ran out of momentum in the near term. And as I pointed out a week and a half ago, with the rising VIX that was also rising with the stock market, that just tells me the market's not in a good position to handle bad news. That's what I talked about a couple of weeks ago. And now here we are, we're getting bad news, and you can see the market's not handling it very well. Market was already a little nervous. And so it just sets us up for the potential of more short-term weakness. It doesn't always happen, but in my opinion, when you see the VIX rising with the S&P 500 and that correlation between the two starts to turn positive, that's just when you maybe want to think about being a little bit more cautious, whether that means more cash in your account, whether it means maybe selling calls against your positions, whatever it means to you individually. Maybe it's put insurance on your account. Maybe it's shorting for some of you who are aggressive and just don't believe in this rise in the market. I've certainly believe in it. I've been talking about it for a long time, and I think we go a lot higher, but that doesn't mean everybody has to agree with me. Two sides of the market. If you're looking to short, I think the best times are when we start seeing signs like the one we had a couple of weeks ago. I don't short. Rarely do I short in a secular bull market. I just, if the tide's going with you, why do you want to turn around and swim the other way? That's just one of those things. It's just harder to find shorts in an uptrending market than it is in a downtrending market. Downtrending market, it's very easy to find short candidates. All right, so looking at the S&P, I mean, there's your breakout back in September. Let me annotate here. Beginning of September, we topped, and then we came back up and broke out. I'm going to say, 45.30, 45.40. We now have the 50-day at 45.36. That's an area I'd like to see things turn. If we go down through the 50-day, I think potentially we're setting up possibly 4,300. And I just don't see that happening right now. Could we go to 4,300 in 2022? I think we could. I don't know. It might be after we go back and up and break 5,000. We could maybe have some sort of a, maybe a cyclical bear market or get close to it. Definitely a correction, I think, could be coming in early 2022. Just based on what I'm seeing and how the market's looking. I'll be talking about that more in Market Vision 2022. We're putting together some of the planning right now for that event. We'll be getting that out to everyone soon. But I'll definitely spend more time talking about that at Market Vision 2022. But here, if we break below the 50-day and we break below this price support, then yeah, I mean, it definitely brings 4,300 into play. I wouldn't expect it here in December, which tends to be a very strong month. But history and historical tendencies, they don't guarantee us anything. They give us probabilities, but they don't guarantee us anything. If we start breaking down technically, I think you have to at least consider 4,300. So that's why I'd like to see us turn here fairly soon. When we were at 4,600, 4,650, I talked about the possibility of going back down, losing 2 or 3%. And I think we're, certainly well on our way to doing that right now. All right. let's talk a little bit about Apple, because market went down, but Apple certainly did. And look at the volume coming in. Biggest volume day since back in March on this breakout. And if you look, this move to the upside has been on heavy, heavy volume. And some of you might say, well, yeah, but look at the volume back here. It was so much heavier. Well, the price action, look where the price was, 115 to 125. So multiply the number of shares times 115 to 125. That'll give you the dollar volume. Take this times a much higher dollar per share price, and you're going to get a much higher dollar volume. So you got to be careful. You don't want to be fooled just by looking at volume. When you have a stock that's gone up quite a bit, you really need to take the volume times the price to get a better sense of the actual volume on the stock. This is one thing that I have asked stock charts for, is dollar volume that you could do on the chart as opposed to share volume. Because especially, I've had so many people talk to me about the fact that Apple doesn't have volume anymore. When you look at a long-term monthly chart, you look back in 2007, 2008, 2009, 10, look at the volume bars. And now we're up here and look at the volume bars. And I can't tell you how many technicians I've seen write about this and talk about how volume is not supporting the move to the upside. You got to take the share price into account. You can't just say, we're trading at $170. Back then, it was the equivalent of $5. You think the volume bars are going to be the same? Of course not. So be careful you don't fall into that rut. I've seen plenty of technicians do that with stocks that have made big moves. Of course, the volume today isn't going to be the same volume it was back then. All right, let's keep moving on. I wanted to show you this XLC. So I put this in the daily market report yesterday for our members, but if you're not a member, let me just point out here. So in essence, what we have is a neckline coming across here. And actually, we've got a slight downtrending neckline, so a little bit of a down slope to it. And I find personally that to be a little bit more bearish. I see a lot of people drawing, something like this and saying, oh, there's a head and shoulders. If you break this, then you're in trouble. Well, except you still haven't broken these price support levels. When you're downtrending, when you break that neckline, you've broken these support levels. You can't break the neckline without breaking a support level. So I think a lot of folks use the head and shoulders too often. And, they call everything that, kind of moves lower as a breakdown. I'm trying to find one. This might be a little bit of a stretch, but even something like that, left shoulder, neckline, head, right side of the neckline, right shoulder, and boom. Well, guess what? You came right down to this prior price support and then went right back up. That wasn't a head and shoulder. That was just moving down. It's trying to find patterns that aren't there. So I would just be a little careful of that. But, when we start seeing big breakdowns like this, that definitely gets my attention. And this is one of the three big sectors. So, this is definitely one check mark, maybe in the bears column. I would say not just in the short term, but maybe even into the more intermediate term. And then when you're looking at doing a measurement on this, what you do is you take the top from here, and this will just kind of give you an estimate. I didn't quite draw that line perfectly, but right about there, we drag this down just a little bit. Something like, 8.3, 8.4%, top straight down to the neckline. And what this does for you is it gives you the opportunity to measure a move to the downside. So now that we've gotten this breakdown right here, what I can do is I can drag this down to about 8.38%. And that's 8.38%. So right there, somewhere in the 72 area. So what I would then do is look over here and say, well, where in the 72 area? Well, there's support there. There's this breakout right here and this pullback to test. So maybe the 70 to 72 area, or I might say, might use these lows and just say, well, as I get down maybe to this low around 74, maybe I want to start thinking about, things turning around. The other thing you can do is once you find a target on the daily chart, go back to a weekly chart and see if it makes sense on a weekly chart. So does $72 make sense if you're looking at a weekly chart on the XLC? Well, I pull it up, 72 comes in here. Not really. I mean, we are breaking that 50-week moving average, although if we reverse back, we could put in a hammer. You know, we still got a couple of days left this week. Today's Wednesday. So if we finish strong this week in the XLC, potentially we could put a hammer on the 50-day. That would be much better looking than this right here. I mean, right now we're back at the center line on the weekly chart. We don't spend a lot of time below the center line. So this is an area that I would certainly be, you know, starting to feel pretty good about with communication services, but I don't like this breakdown. I'd rather see a reversal first. All right, let's move on. The next thing I wanted to do was go through chart lists. And if you're not familiar with chart lists, I'm going to show you real quick. So if you're a member at Earnings Beats and you're also at least an extra member over at Stock Charts, what you can do is you can come in. This is just the page, the member portal, as soon as you sign in. But if you go under the stocks to chart lists, we have and we're going to be working on trying to streamline some of these pages, by the way, to make it a little easier. But if you go down to, say, the strong earnings chart list, you can put this password in right here. Just I highlight it and then I hit copy. And then I click on the stock charts link. And that brings me to a page where I can now download with the password given. I can paste it, hit this unlock list, and now I have all these charts. So I can come in and look at the strong earnings chart list. But if I have an account at Stock Charts, you'll see this save to chart list feature over here. So now what I'm going to do is hit that save. Now I already have a strong earnings chart list, but I can replace that list. So all I have to do is hit replace list and then come down here and hit strong earnings and then save results. Now, because this is such a huge chart list, it'll take, you know, maybe 15, 20 seconds for everything to fall into place and to download into the chart list. But I can only tell you that I probably have spent on this chart list probably 40 hours. I bet I've spent a week putting this together, doing the research, adding the charts, and then doing the annotations, because I annotate every chart on this list. This one's taking a little bit longer. Usually it doesn't take quite this long, but it should be done here in a second. But all the work I do, there you go. So now I can view my chart list. And if I pull it up in edit format, it'll tell me how many are on here. So there are 541 stocks on here. They're in order. Basically, they're chronological order. So the ones that are the first on the list are the ones that reported earnings the longest period ago. So these will be the first ones to come off the list, because as they approach their earnings, we'll take them off the list. And then if they beat top and bottom line, they look good on their charts, then we'll add them again. And all these stocks have to meet certain liquidity requirements. So they, you know, we're not going to put a stock on here that averages trading 5,000 shares a day. We want to get at least a couple 100,000 shares a day. So we make sure that they look good technically, that they're liquid, and that obviously they've beaten earnings and revenues estimates. That's how they get on the strong earnings chart list. But then all of this is just kind of tied up and a little bow put on it, and we hand it to our members. And you saw what I did. That's how quickly you get all of our research and then can go in and start taking a look at the charts. I mean, now remember, I annotated this 3 months ago or 2.5 months ago. So you can see this probably came in after I annotated. So we broke through the support. Some, though, will turn right at support. And so you can just kind of flip through. Here, this one, I'm sure this one was set up. There was a support level. Look at that hammer, print right on support, and then right back up it goes. So that's the advantage of having this, these different chart lists in your account. So, and we've got probably, I don't know, 20 or 25 chart lists now that our members can download. So it's pretty cool. All right, earnings spotlight. Wanted to just talk about for a second, Salesforce getting hit pretty good in pre-market. Market's going to open in about 30 seconds, but let me just show you CRM down 4%. Give you a couple. Zscaler. This one is up 7%. AMBA, the best reaction I saw, up 15%. And then another one, this is Box, which is Box Inc., up 12%. All of these with earnings coming out yesterday afternoon. So they all look pretty good, other than obviously the Salesforce.com. But I want to go back and I want to just show you now that the market's opened. I'll try to wrap this up really quick. But Salesforce.com, if we put this on a relative chart, and this is what I was, talking about, I think yesterday on my show. If you scroll down, Salesforce for the last 10, 12 months, really just kind of going sideways. I mean, we had this one good period of strength, but we were weakening again going into earnings. I just wasn't blown away going into their report. I didn't feel like it's a stock that I'd want to take a chance with holding into earnings. And now we see the stock, gapping down 4%. Now it's got good gap support here from 260 to 270. Maybe we'll get into that range today, but close below 260, I think would be pretty bearish for Salesforce. Last thing we'll do here is the 3 you must see. Let me go through these kind of quickly with you. JAKK. This one it put in this low, which went below the prior support, but it came back and closed above. So I would look for a little bit of short-term strength here. Did it open up about 26 cents, but I think a move back up to about the 1160 area is what I'd look for in the short term. MTZ, this is Mastech. Big volume came in on the break of this downtrend, and now it's coming back down on lighter volume. I think this 90 level is an area I'd watch pretty closely. And we were at 103, 104, and yesterday we closed back down in the low 90s. I just wanted to point this one out. It's getting close to an area which could be interesting for a trade. And then Lumen Technologies into this gap support zone. Big volume on this gap up, closed below the gap, which I'm kind of surprised. So maybe this 1195 up to about 1260 area, I'd be looking for that area to hold as support. One downside, though, here on this stock, the AD line, continuing to set new lows. So anyway, just wanted to point those 3 out. Quick look at the market, and we'll wrap up for today. So we have opened up, and currently the Dow is up 249, S&P up 48, NASDAQ up 181 on a relative basis. Right now we've got leadership in the NASDAQ. Good news, small cap and mid cap are both showing a little bit of relative strength. We'll see if that holds throughout the day. We've got the VIX moving back down. Welcome to the market's yo-yo world right now. Don't know what's going to happen the rest of the day or what could happen tomorrow morning. I can tell you historically, this is the first day of the calendar month. Normally there's new money coming in, and usually the stock market goes up at the beginning of the month, the first week of the month. We'll see whether or not that holds true this month. Anyway, everybody have a great day. I'll be back tomorrow over at Stock Charts TV at 9 a.m. If you go over and click on Stock Charts TV, you'll be able to tune into the show. That will be the next episode of Trading Places Live. Have a great Wednesday, everybody, and be back tomorrow. Happy trading.